I'm here. I'm at the University of Illinois. I've been there since 2007. I do have a farm background. I grew up on a corn and soybean farm in southern Minnesota. One thing I get to hear when my dad comes down to visit is how easy all you guys have it in Illinois with all this flat black dirt, and I have to remind him that the price of that flat black dirt's a little bit different than it is in southern Minnesota. So anyway, this morning I'm going to talk about, Dan Davidson asked me to talk about crop returns and risk management with lower prices, so I think something that is going to kind of naturally fall in line behind Dr. Cole's presentation. I'll walk you through some numbers using some of the data that we have from some of the farms that are in the Illinois Farm Business Farm Management Association. So we'll take a look at some crop budgets on the revenue side, take a look at where we've been recently, where we're at, where we think we're headed, at least in the short term. Take a look at some of the cost sides as well, talk a little bit about where some of these cost reductions that everybody's talking about that need to take place, where some of those might come from. And then towards the end, I'll talk a little bit about risk management in this economic reset, if you will. As Dr. Cole said, you know, we're now in an environment where the volatility is going to present opportunities, but it's also presenting much bigger financial risks than a lot of us might be used to in terms of moving forward. So I'll talk a little bit about crop insurance and then some of the new government programs that we have that came out as part of the 2014 Farm Bill, and talk about understanding how those work in the kind of lower, potentially declining commodity price environment that we're in relative to how they've worked in the last, especially crop insurance, how they've worked in the last 5 to 8 years when we've had much higher commodity prices. All right, so we'll get started here just looking at some crop budgets, again, just to paint the picture that we're all familiar with here. Take a look at a corn budget here for Central Illinois. Again, these are all based on Farm Business Farm Management Association numbers. Hopefully you all can see these things in the back, and I would draw your attention to a couple numbers I'm going to come back to in some future slides as well. The operator and land return row there, so the first bolded row in that table, and then some of the farmer return numbers there that are in the bottom row. And you can see that if we look at those operator and land returns, what that number is measuring is crop revenues minus the non-land cost of production. So we use this margin, this return number a lot of times to look at the money that's left over or available to cover land costs, whether that's ownership costs or rental related costs. So if you take a look at those operator and land returns, you can see we had a quick increase and spike in the 2010 to 2012 period, anywhere from $400 to over $600 available per acre to cover those land costs. But we've seen a very quick fall and return down to levels that were more normal for us prior to that 2009, 2010 crop years. And then if we add on what we've seen happen on the land cost side, and what you're seeing there for land costs is the average cash rent level that we're seeing in this area of the state, at least in Central Illinois. You can see that those land costs have come up quite dramatically. Some adjustment we're looking at for 2016 and in future years, but farmer return levels going into in the red there for 14, projected for 15, as well as projected for 2016. If we look at soybeans, it's a similar story. So again, we saw a spike in the money available to pay cash rents to cover land ownership costs, anywhere from in that mid $400 range in the last 3 to 5 years. But those operator and land returns have come back down with lower price levels. Land costs came up quickly, adjusted quite quickly, and now we're looking at negative farmer returns back in 14 for the 15 crop year, and then also looking ahead to the 16 crop year for soybeans. If we take a look at then kind of getting away from the per acre crop budget side of things and take a look at net farm income, I think this is an interesting chart to look at, or an interesting way to look at the net farm income situation. We're really getting back to income levels, projected income levels, where they were at in that late 90s to early 2000 period. So again, based on Dr. Cole's straw poll of the ages in the room, probably the majority of you are familiar with that late 90s, early 2000 period where we had 5, 6, 7 years of low commodity prices, some of the struggles that we had there. So we're really looking at potentially being in a cycle very similar to that time period. So income levels and price levels, relative price levels anyway, back to where we were at in that late 90, early 2000 period. So on the price side, we'll start this time with soybeans. Whether we're looking at corn or soybean prices, if you look at prices historically over the last 40 years, so going back to the mid-70s, it's interesting. It doesn't really matter which commodity you look at, but it's fairly obvious that there are a couple of different price regimes here. So if we look at the 30-year period from 1975 to 2005, of course, we had volatility around the average, but we saw soybean prices average around $6 per bushel. With the commodity boom that we've experienced over the last 10 years, again, price levels above and below this new average, but looking at average soybean prices since 2005 in that $10.50 to $11 range. All right, and the experts I work with at the University of Illinois, Scott Irwin, Daryl Good, they're still saying that we have entered a new era, and we can and should expect a higher average soybean price, a higher average corn price in that $10.50 per bushel range for soybeans, in that $4 to $4.50 range for corn moving forward. But we're going to have years like times we're experiencing right now where we're below that average, just like we had times in the last 5 years where we were well above those averages. All right, so it's all about understanding where that average price level is, managing the business and managing the risk around those new averages. Again, if we take a look at corn prices, again, a very similar picture. The price levels themselves are different, but down in that $2.40 range over that 30-year period from the mid-70s to the mid-2000s, and then looking at the last 10 years jumping up into that mid-$4 range. Again, we're expecting to remain there in terms of a new average, but we need to be prepared for prices below that and not maybe expect or need to see prices above that to be profitable moving forward. All right, so we'll take a look at the cost side as well. So for non-land costs, again, we've seen an adjustment in those historically. So just in the last 15 years, so this chart shows, again, based on those Illinois farms and the Farm Business Farm Management Association, what we've seen the non-land production costs do for both corn and soybean production since 2000. So you can see the significant increases we've seen there. We're now in that $500 to $600 range before we even pay for land for corn, at least in central Illinois. And for soybeans and a standard corn-soybean rotation, we're looking at costs getting up towards that $400 per acre range, again, before we even cover some of the land costs that we have. So in both cases here, we're looking at a doubling or more in terms of the costs of production that are going into corn and soybeans just in the last 15 years. All right, coming back and taking a look historically at that operator and land return. Here we got for corn acres in blue, soybean acres in red. You can see here that we've had a run-up in prices. We had some good yield years. We've also had a run-up in costs. What's been the net effect of those two? Well, we've seen in general returns come up. Again, this is that operator and land return, so it's that margin that's left over that's available to cover some of those land costs. And we can see here the quick run-up from, kind of starting in that 2005, 2006 period to some of the highs that we reached, $500, $600 per acre, especially on corn acres in 2011 and 12. And we can see here that those land costs as measured by cash rent levels have followed those return levels. So more money that's available creates competition in that land market. we get higher cash rent bids, and we see average cash rent levels come up as well. So the problem here in the picture that we're looking at is what kind of situation are we in for 2014 and projected for what we experienced in the 15 crop year and what we're looking at for the current crop year in 2016. Well, that operator and land return now is actually below that cash rent level. So we're seeing an adjustment back far enough to where we're looking at not even being able to generate a margin sufficient to cover some of the average cash rent levels that we're going to see. All right, so again, a need to address some costs, identify areas where costs can be reduced to kind of reverse that situation. All right, again, some of the numbers here are relatively small. The main thing I want to highlight on this chart here is just get into some of the individual cost areas that are included in our budgets and where the majority of that $600 in non-land or $600 in production cost per acre for soybeans is going. So I have on the gross revenue side at the top, and then I have some of the individual costs that we track in that Farm Business Farm Management Association data. And I sorted those by the areas with the highest cost in terms of the 2015 crop year. And the top 5 cost categories, it doesn't matter if we're looking at corn or soybeans here, but the top 5 cost categories are cash rent, seed, machinery depreciation, so capital costs, non-land capital costs, fertilizers, pesticides, and chemicals. All right, those costs account for, of that $650 in 15 or $600 in projected for 2016, well over $500 per acre. All right, so all costs are important, as Dr. Cole said. You know, making big change can come from making small changes in a number of different areas. But if you're looking at the grouping of 5 costs that account for $500 of the $600 you have in total costs, those are the areas that you need to see adjustments in. So obviously cash rent is the biggest one there that basically accounts for half of our production costs that we see for corn and soybean growers in Illinois. And then some of those inputs and some of those machinery costs are the places that we need to look where we can have the biggest impact in terms of bringing some of those costs of production down. All right, I'm going to talk a little bit about what we think we're going to see on the capital side, on the machinery side, what we think we're going to have to see on the cash rent side. I don't have a whole lot of additional information on the seed, fertilizer and chemical side. What we can say is that historically we haven't seen examples of periods where we've seen big reductions in seed costs. So whether you think seed companies are going to lower costs to accommodate growers in situations like this, or farmers adjusting their seed choices to significantly lower seed costs, that's not necessarily something we expect. We have seen some pressure relief in terms of chemical prices, especially on the nitrogen fertilizer side, compared to some of the highs we have experienced in the past 5 years. But again, you know, the ability to make changes there is probably going to be somewhat limited to the prices that we have to take in those types of markets. So let's first take a look at that machinery, that depreciation side of things, and take a look at what capital purchases have looked like on some of these Illinois farms that we track in this management association. So you can see here that again, during the commodity boom, higher returns, higher income levels, farmers used a good portion of that, or at least a portion of those higher incomes, the cash that was generated over that time period, to reinvest, to retool in their operations on the machinery side. So we saw capital purchases triple, at least double, sometimes triple in some cases on a per acre basis in terms of what's being spent for things like machinery on an annual basis. We saw a fairly large adjustment of that already in the 2014 crop year, and we're expecting to see continued adjustments in that capital purchase area back down to those levels that we were looking at in the early 2000s. Again, we're back to income levels that we experienced during that time period. We're expecting to see capital purchases adjust back down during that time period. Again, if your operation is in the position where maybe you held on to more of that cash, you weren't as aggressive with some of those capital purchases, I think you can look at this as a positive in that perspective. Dr. Cole mentioned this. I think there's going to be a lot of opportunities both on the new and used machinery market if you hadn't made some of those investments and held some of that cash over the last 5 years. All right, cash rents. This is always a very popular topic to talk about with people. I'm guessing that there are landowners, potentially landowners in the room, as well as farm operators who are paying cash rents, so I'm guaranteed to upset at least half of you probably, regardless of what I say. But again, we'll take the first picture here we'll take a look at is what the average cash rent level has done in Illinois. And I'll draw attention to a couple of things here. First of all, other than the farm crisis in the 80s, we don't have a real good example historically of fast adjustments downward in cash rent levels. And that's true for most expenses, but particularly in cash rents. So we did see that big adjustment in the mid to late 80s, a pretty steady rate of increase from the late 80s, leading up to that commodity price boom that started 05, 06, and then an even faster rate of increase as cash rents adjusted to those higher margins available to pay land costs that we've seen in some of the earlier pictures. All right, 2014, the average cash rent level in the state of Illinois was $232 per acre. 2015, we saw a slight adjustment in that down. First time we've seen a downward adjustment in that average statewide cash rent level for many years, but a very small adjustment down to $230 per acre. All right, so already starting to see, even in the averages across the state, some adjustment in these land costs. All right, another complaint, critique I get whenever I start off or show this picture at all is that doesn't represent my farm at all. We've got $500 cash rents in my county. How can the average be $230? Well, that's USDA. That's on USDA. That's the average across the state. But then what I always try to follow up with is, well, let's look at kind of the more aggressive portion of the market, where land rents have been renegotiated in the last 5 years, maybe renegotiated on an annual basis, and we can go to the Illinois Society of Professional Farm Managers to take a look at what some of those more competitive cash rent markets look like. And this is where we see some of those higher cash rent levels that you hear about in the news. All right, and the Society of Farm Managers, they break out their data. They do a survey with their farm managers across the state where they break out their soil qualities across good, really excellent farmland, which is classified as yield potential for corn of 190 bushels or more, good farmland, average farmland, and then some fair farmland. All right, so we got a lot of excellent farmland, central and northern Illinois. More of the fair and average land is in southern Illinois, but it's all based on productivity. So let's take a look at what the 2014 cash rent levels, the averages were across the state. $293 for really good land, $243 for good land, under $200 for average land. But if we take a look at some of those professionally managed farms in those categories, all right, we can see that's where we see the cash rents approaching the $350, $400 mark for the really good land in 2014, still over $300 per acre for that good category, close to $300 even for average farmland, and even over $200 for some of that fair ground that's professionally managed in the state. Okay, so that's where those high cash rent levels that you hear about are coming from. It's the land that's been renegotiated recently and been negotiated on a pretty competitive basis. Well, what do we see in 2015? Well, we see bigger adjustments in some of those cash rents that we see where we do see some of that renegotiation activity. So we look at the USDA average for the state and we say, well, cash rents aren't coming down. They went from $232 in 14 to $230 in 15. I thought we needed to see bigger adjustments in cash rents. Those adjustments are happening. They're just happening in smaller cross sections of the market. And it's the land that went up faster in the last 5 years that's going to come down faster in the next 2, 3, 4, 5 years. So a fairly big adjustment in all the categories here we see from 2014 to 2015, even bigger adjustments being expected or projected on those professionally managed farms for the 2016 rent levels that we'll see that are probably already set, probably already been paid in a lot of cases, or will be paid coming up here not too far away in the spring. All right, another thing that I always find kind of interesting to try to talk about with groups is, guys like Gary Schnittke will tell you need to come up with $100 in cost savings. A good chunk of that's got to come from reducing cash rents, and then, how do you actually do that? That's something that's a lot easier to stand up here and talk about doing than it is to actually implement at the farm level. So one thing that everybody always talks about and is important, but I do realize is much easier advice to give than to actually implement, is you just have to have real good information, financial information about what your cost of production is, what your individual farm budgets are if you're going to try to initiate those renegotiations with your landlord, and just be very open in terms of communication in providing that information about what the economic environment currently is with that landowner. Again, it's difficult to do. Hear a lot about how it's hard to start those conversations, especially with absentee landowners who maybe don't even live in the area, are a generation or more removed from agriculture, don't understand. They just hear that you made a ton of money the last 5 years and feel like they need a part of that moving forward in terms of higher rent levels, regardless of where prices are today. So again, an easier piece of advice to give than actually implement. Another thing, and I'm going to, this kind of fits on well with some of the liquidity issues, working capital issues that Dr. Cole talked about, is you really need to sit down right now. It's very important to assess and know what the financial position of your farm is, particularly from a liquidity perspective. All right, so how much working capital do you have available? What's that working capital going to look like 1 year from now, 2 years from now, at different cash rent levels, at different commodity price levels? How much cash do you have available to kind of get through this reset period? So again, if we look historically, we can get some guidance here. And talking to the folks in the FBFM Association who work with the farmer cooperators, the field staff in that association, talking to lenders throughout the state, what they would like to see, the piece of guidance, advice that we get on the liquidity side moving forward, is that they would like to see farms with at least a current ratio of around 2. All right, so twice as much liquid assets available to cover those short-term liabilities that you need to cover, some of those short-term liabilities and expenses. If we take a look historically, the panel to the right there at the top shows you what that current ratio has looked like on average for FBFM farms going back to the mid-90s. And you can see we were right around that average, or maybe just a bit below that average of 2 on that current ratio for that 20-year period for that 10-year period from the mid-90s to the mid-2000s. Built up a lot of liquidity over the last 10 years. Current ratios on a lot of farms went well beyond 3, 4, 5. On average, we hit 3 in 2012 for Illinois FBFM farms, and we've started to see an erosion of that working capital, a reduction in those current ratios, a reduction in that liquidity in the 2013, 14, and 15 crop years. If we talk about working capital on a dollar per acre basis, another thing to keep in mind is that if you look back to how much working capital you had in that mid-90, late 90, early 2000 period, that's not going to be sufficient capital moving forward. We're working with a lot more dollars at risk with those higher production costs on a per acre basis. So that $200 in working capital that we saw in the bottom panel there in the late 90s, early 2000s, that gave us a current ratio of 2 then. That means that we need probably $400 in working capital, twice as much working capital as we did during that time period to still be in that same relative liquidity position. All right, so again, we built working capital from 2005 to 2012, reached over $700 per acre on average in Illinois on FBFM farms. Seen an erosion of that working capital the last few years. Still in a very good position. Farms are still in a pretty solid position. Definitely from a solvency standpoint, even still from a liquidity or cash flow standpoint, but that can be eroded very quickly when we're looking at $100 negative returns in some of our corn and soybean budgets. All right, the last area that we've started talking about more in terms of how do we control land costs, how do we bring some of those cash rent levels down from where they've reached the last few years, is looking at, rather than trying to negotiate that cash rent down $50 or $100 in a single year, trying to talk to the landowner about moving towards a different type of lease agreement. And we're calling these things or referring to these things as hybrid or flex designs. And basically how these hybrid or flex leases work is I view them as a midpoint, if you will, between the extreme of a share rent contract where the landowner's involved making production decisions or helping making production decisions, directly covering some production costs, versus the other extreme of the cash rent contract that we've seen such a movement towards, where the farmer's paying a fixed amount of money to farm the land, make all the production decisions. All right, going back somewhere in between those two, what we're typically seeing in these types of agreements is some kind of base rent level, so a fixed component, very similar to a cash rent, something lower than what you would currently be paying for a fixed cash rent level, and then adding a bonus structure into that is somehow tied to how much the farm yields, what price levels are, what revenue levels are, some type of index that triggers a bonus if economic conditions are good enough to justify that bonus. And what we see here, the way that we talk to farmers that have successfully implemented these types of agreements on their operations, the positives that they use when they're talking about these with their landowners is that while it does reduce some of the losses for the farmer when we're in poor return years, it still provides that landowner with some of the upside potential if we did see a positive surprise in revenues from a price increase from where we think it's going to be, or higher yield levels than we might be including in our budgeting activities. All right, so again, it goes back to some more of that risk sharing that we see in share rent agreements, but it removes some of the headaches that we see in terms of involving the landlord in production decisions. So again, kind of a midpoint in between the traditional share rent and traditional cash rent. We are seeing a lot more popularity with these types of agreements, particularly on some of those professionally managed farms. So a lot of the professional farm managers in the state, when you talk to them, this is what they're going to in terms of negotiating those contracts between the landowner and the operator. All right, so will rents come down, or maybe how fast will rents come down? I gave a presentation on cash rents back in December as part of our Farm Doc series of meetings that we do at various locations in the state. And I kind of gave the classic economist way of approaching things, and I said, well, rents might come down, but they might also go up. So just talk about a few reasons why we might see that. So again, will rents come down? Yes. I think there are a lot of obvious reasons that we've talked about this morning, both in Dr. Cole's presentation, some of the budget and income numbers that you saw in my presentation that suggest that they must come down. So again, looking for $150 to $100 per acre in cost reduction. And I think we have seen evidence of that, again, particularly in some of those higher end rents, the more competitive rental markets, and we will continue to see adjustments in those cross sections of the rental market. Okay, but what I always also try to caution audiences about is that you can't necessarily expect every cash rent level or even the average cash rent level that people talk about in different areas to come down or to come down very quickly. All right, and the reasons for that are, one is not all cash rent contracts are renegotiated every year. Okay, so they're not all in that competitive, professionally managed market. We still have a lot of below average rents. Okay, so remember, go back to that first cash rent chart that I showed you. The average cash rent level in the state is around $230 per acre now. Some of the professionally managed rents, higher end rents, are $300, $400. If we got $300, $400 cash rents and an average of $230, that means there has to be quite a few rents still below $230 as well, right? Okay, a lot of that might be poorer ground. Maybe rent shouldn't be that high, but there's probably also areas where rents aren't even as high as they should be today, okay, even with lower prices, given the quality of the land. All right, the third point is a really important one. All right, it's one that I think is the big guessing game now, especially from the lender side, is we are in a very strong financial position. There are farms, there are operations that conserved a lot of that cash that was generated in the last 10 years. And the big question is, how long can these farm operations sustain some of the negative return numbers that we're looking at in our crop budgets before something has to give? Okay, it's very hard to give up a farm not be willing to pay that high cash rent level, knowing that there might be another farmer in your county that has the money and is willing to come in and pay the same rent level you were paying. All right, so again, a lot of strategies we've heard from farmers is, well, I've got the cash, I'm going to lose money, I can lose money this year, I want to keep hold of the land. That's a fine strategy if you're in the financial position to do it, but something that both Gary and I have been trying to emphasize with groups is that, okay, maybe your cash rent level doesn't work with $3.90 corn or $3.80 corn or $3.70 corn and $9 soybeans, but it better work with $4.50 corn and $10.50 soybeans. Again, those are those long-term average price levels that we're looking at. If your cash rent level isn't working at those levels, then I don't know what your medium or long-term strategy is for holding on to that farm. All right? If you're expecting $5 corn consistently, I think you're being overly optimistic. If you're expecting $12 soybeans, again, I think you're being overly optimistic. So it maybe doesn't have to adjust down to a profitable rent at $3.80 corn and $9 beans, but it should be something that you can survive at $4.50 corn and $10.50 beans. All right, so what about land values? Again, heard a lot about interest rates in the last few months. Dr. Cole talked about interest rates earlier. Get a lot of questions now about lower income levels. If cash rent levels come down, what's that going to do to land values in the state? And I think Dr. Cole made an excellent point about how much different a position we're in today relative to that 80s crisis, where we did see a very quick and big reduction in farmland values following the crisis or during the crisis. Okay, and this is the picture that I try to illustrate that with from a pretty basic finance perspective. So first thing to point out here is the blue line, which is labeled farmland price here. That's the average value of farmland across the entire state of Illinois. Again, doesn't represent good quality farmland in central Illinois, northern Illinois. Doesn't represent the poorer ground that we see in northern Illinois or in southern Illinois. But the average price of land, when you combine all that stuff together, is about $7,800, $8,000 per acre. Or that's what it has reached 2014, 2015. All right, you can see that that's come up considerably from the early 70s. We had the quick ramp up in the 80s, the decline in the 80s, and a pretty steady trend upwards in farmland values since the late 80s. All right, the red dash line is labeled capitalized value. All right, the way I explain this is the implied value based on what the average cash rent level for farmland is, so the income generating potential of the farmland asset, and where we see the interest rate markets in terms of an appropriate discount rate for that income stream that farmland can generate. Okay, so people talk about cap rates and how you can use those to generate an implied asset value. That's what this capitalized value is. So what kind of position are we in today? We have capitalized values that have grown much faster in the last 5 years, 6 years, 7 years, and capitalized values now that exceed the actual market price for farmland. What does that mean? That means that does that mean that farmland values should be higher? No. Does it mean they could be higher? Maybe. What it means is that with the very low interest rates that we've had and the increase in cash rent levels that we've seen on average, if the market viewed those things as being permanent, so if we thought $250, $300, $350 cash rent levels were here to stay forever, and we thought that a 0% federal funds rate, 3% 10-year treasury rate was here to stay forever, that yeah, farmland values could be higher. But what's the actual market done? It's been more conservative than that. Okay, so even though, yes, farmland values have come up, we have talked about, are they in a bubble? Are they too high? Yeah, there's going to be some adjustment in farmland. But we've been relatively conservative in the farmland market. And it's much different if you look back at the 80s. In those cases, we had actual values exceeding what the current market conditions would have implied. All right, so there it was, we were overly optimistic that interest rates would go lower or income levels would go even higher than what we were experiencing during that early 80s time period. All right, the blue line above the red line here. All right, so I think, again, we're going to see some adjustment land values. We're going to have to, but I don't think we're going to, I don't think we need to worry about a 30% drop or a 40% drop in a year. All right, let me quickly try to wrap up now and talk a little bit about, so how do we manage risk? So again, just show you a few examples on crop insurance, a few examples on the commodity programs. The point that I want to get across here in the last few minutes is that I continually hear this, and it's true. We do have access to we're in the best position historically in terms of having access to good risk management tools like crop insurance and the new commodity programs that we have. We have good tools in place to help manage that revenue risk that we're facing. Okay, but you need to understand how those risk management tools work. And the point I'm going to try to make here is that, particularly for crop insurance cannot be expected to work and do the same things for you this year, next year, the year after that it did from 2007 to 2012. All right, and I'm going to start here first by making the point that crop insurance, the revenue that you can lock in, the revenue that you can protect, the way crop insurance is designed is directly tied to current price levels, and specifically what we expect price levels to be at harvest time starting on Monday, right now in the spring. So our price level that determines the guarantee that you can make this year for your 2016 crop insurance is going to start to be determined on Monday, February 1st, based on the December contract, the harvest contract for corn, and the November contract for beans. Okay, so the fact that we have lower price levels now, much lower price levels now than we did over the last 5 years, means that our crop insurance guarantees are going to be much lower as well. All right, and if we take a look at examples for both corn and beans, all right, again, $800 total production costs, land and non-land costs for corn. That was our Central Illinois budget number, roughly. If we take a look at a Central Illinois farm with 190 bushel crop insurance APH yield, a $4 projected price, which is optimistic compared to where corn settled yesterday and where I think it's at today. I think corn's closer to $3.80, $3.85 on that December contract. So even if we get a $4 price average throughout February, that only implies a $760 expected revenue. And then you can only guarantee up to 85% of that on your individual revenue plans. All right, so best case scenario is you're looking at maybe $650 in revenue protection. That's still $150 away from production costs. Look back at your records going back 2012, 2011, 2010. Those were years where you could lock in a gain with crop insurance, even with the standard revenue contract that didn't have the harvest price protection. All right, so we're in a much different situation with lower prices in terms of what crop insurance can do for you. Still very important, still an extremely useful tool, but you have to understand how it works in a lower price environment. Same thing for soybeans, $600 per acre total costs. You got a 60-acre APH yield. If we're looking at a $9 projected price, again, we don't know yet. Right now, that would be optimistic. That'll be determined in February. $540 expected revenue, and you can protect up to about $460 of that. Still $140 away from that production cost level. Same situation as corn. Last 5 years, you could maybe lock in a gain with that 85% policy. Here, you're still exposed to quite a bit of risk. All right, very quickly on the commodity program side, I've got PLC listed here, but the truth of the matter is the vast majority of you, vast majority of corn and soybean base, virtually all the corn and soybean base was enrolled in that Art County program. I guess you can blame Gary Schnittke and I for that, for telling you to do that if you went to any of our meetings the last couple years. Still looks like that was the best choice, will be the best choice moving forward, so I'll focus on that. The situation we're in, again, understanding how these programs work, you get the payment for a crop year at harvest during the next crop year. So your 2014 payments, if you got any, probably showed up at some point last fall. If there's a 2015 payment, we're not going to know that until August, and you'll get that at some point during harvest this year. 2016 crop year payments, you won't get till 2017. So The low prices that we think we're going to have for the rest of this 2015 marketing year looks like there will be some pretty likely payments on corn base. But with soybeans, even with the lower prices we're seeing, because of the higher yields that we're expecting, the higher yield numbers we're expecting for the 2015 year once they release that information, not so likely that we'll get a payment on soybeans in 15. If we continue to see lower prices, which is what we're looking at, the 2016 year will probably trigger payments on both corn and soybean base. Again, assuming we have trend yields, we don't have another big, a third year in a row of really good yields, and continue to have those lower prices, probably looking at payments on both corn and bean base in 2016. All right, so points I want to make about the ARC program though, in terms of how that works in a declining or lower price environment. The main reason why these programs have triggered payments in 14 or will in 15 or will for 2016 is the price levels that we're seeing are much lower than the guarantees that we're starting the year off with in those programs. So I'm trying to draw your attention here to what I have highlighted in red. That is the price guarantee component for corn on the left in that box, and then the revenue guarantee component on the right. And you can see as you move down from 2014 to 15 to 16 to 17 to 18, you can see that benchmark price getting smaller and that revenue guarantee getting smaller. All right, so this ARC program uses the last 5 years of prices, the last 5 years of yields to determine what the revenue coverage is this year. Since we've had such high prices, our price guarantee is pretty high right now. $5.29 on corn is the price component of ARC's revenue guarantee right now. But if we continue to see corn at $4 or less, that's going to come down. The revenue covered by these programs is going to continue to adjust if we continue to remain in these at these lower price levels. All right, so just like crop insurance, over time, there's a slower adjustment to the ARC program, but over time, we're protecting a smaller amount of revenue if prices remain low. Same thing on the soybean side. We're at a $12.27 price guarantee on soybeans for that ARC program. But if we keep seeing $9, $10 beans, that's going to come down, and we'll see the revenue guarantee for that ARC program come down as well, or the amount of revenue protection that it provides. All right, my final slide before just some summary points here. I did want to just say a few things about interest rates and draw that back to another, just make another point about how we are in a much different environment now than we have been since the 80s. And you can see here I've got 3 different interest rates charted historically. I've got the federal funds rate, which is that orange line, that's the lowest line in that chart, the one that's been hovering basically at that 0 rate. That was recently adjusted back in December upward. I've got the 10-year Treasury rate, which is the line in the middle. And I've got the long-term farm real estate rate for the Midwestern region from the Federal Reserve charted there also. What's the common thing about all those interest rates over the last 35 years? Consistently heading down, right? So what that has put, the position that's put a lot of farm operations in, or businesses in general, is that if you make a financing or investment mistake today, 5 years from now, 5 years in the future, you could refinance that and make some adjustments to that mistake. All right, that's probably not the environment we're going to be in moving forward. Interest rates may not increase rapidly, but they can't go lower. And we are looking at a period where it looks like we're committed to at least increasing those in a stable way, at least into the near future. So again, we're not going to have that luxury of being in a constantly declining interest rate environment. All right, so just some summary points again. I hope I wasn't too depressing, but lower prices have tightened margins considerably. We are back to late 90s, early 2000 income levels. The big question is where will some of these required cost adjustments take place? It may not be as quick as we'd like. It really depends on how much cash farm operators are willing to burn through, what their ability is to do that. Again, the point I want to emphasize is that we are in a new environment. We are exposed to significant amounts of financial risk. At the risk of offending the people who stood the lower than 40 group, which I am also in. We didn't necessarily live through the farm crisis. We didn't manage farms through the farm crisis. But I always tell people that I have a father who did, and who happened to buy land in 1983 at the high, and then proceeded to complain about paying for it for the next 30 years. So I did experience it from that perspective. Over the last 5 or 6 years, I've heard my dad many times make the remark that anybody could make money in farming in the last 5 years. The next 5 years now might be when we see some of those management abilities really get tested. So I think it's just going to be increasingly important to know your cost of production, to have a good financial plan in place in terms of managing that financial risk that we're facing, and really understand the risk management tools, those crop insurance tools and those commodity programs, and how they can assist you, both their ability to manage as well as some of the limitations given the lower prices that we have. So with that, I think I went a bit over, but not too bad for an academic, and I'll turn it back over to you, Gil.
Thank you. Let's give a nice round of applause for Dr. Nick Paulsen. Thank you, Nick.